Building a crypto portfolio for long-term gains isn't about catching hype or chasing green candles. It's not about timing the perfect pump or jumping from meme coin to meme coin hoping for 100x overnight. It's about structure, intention, vision. A well-crafted crypto portfolio acts like a blueprint for your financial future, a combination of assets chosen not for today's headlines, but for their potential to transform tomorrow. It requires patience, discipline, and most of all, understanding. Because crypto isn't one market, it's an ecosystem. A web of technologies, networks, assets, and protocols, each with its own purpose, narrative, and trajectory. When you build a portfolio for long-term gains, you're not just picking coins, you're aligning with entire sectors of innovation. You're investing in decentralized finance, digital infrastructure, blockchain scalability, interoperability, Web3 identity, tokenized assets, privacy tech, and more. The choices you make today shape not just your returns, but your exposure to the future of the internet and money itself. But where do you start? First, understand your objective. Long-term gains require a different mindset than day trading. You're not here for daily volatility, you're here to accumulate value over years. That means tuning out noise, resisting emotional impulses, and focusing on fundamentals. Ask yourself, what kind of investor am I? Conservative? Aggressive? A mix of both? Your risk tolerance, time horizon, and conviction will guide your portfolio construction. Start with the core. Every long-term crypto portfolio should have a strong foundation, and that usually begins with Bitcoin. Love it or hate it, Bitcoin is the most battle-tested asset in crypto. It has the largest market cap, deepest liquidity, strongest brand, and most robust security model. It's the reserve asset of the digital world. Think of Bitcoin like gold with wings. It doesn't generate yield, but it preserves purchasing power over time and thrives during monetary debasement. For many investors, Bitcoin forms 25% to 50% of a long-term portfolio. Then comes Ethereum. If Bitcoin is digital gold, Ethereum is programmable money. It's a base layer for decentralized applications, smart contracts, and a thriving ecosystem of innovation. DeFi, NFT, DAO, stablecoins, they all started on Ethereum. With the move to proof-of-stake and Layer 2 scaling solutions growing fast, Ethereum has become more efficient, scalable, and aligned with environmental narratives. For many, ETH represents both an infrastructure play and a yield-generating asset through staking. Allocating 20% to 40% of your portfolio to Ethereum reflects both belief in its long-term utility and exposure to the beating heart of Web3. Beyond Bitcoin and Ethereum lies the frontier of the altcoin space. This is where opportunities expand, but risks rise. You're no longer buying market leaders, you're betting on ecosystems, use cases, and adoption curves. To navigate this, you need frameworks. Don't just buy coins, analyze categories. Start with Layer 1 platforms beyond Ethereum. These are smart contract blockchains aiming to solve Ethereum's limitations. Solana, Avalanche, Cardano, Near, and others offer faster throughput, lower fees, and unique consensus mechanisms. Some prioritize decentralization, others prioritize speed. When choosing among them, look at developer activity, TVL growth, ecosystem incentives, and institutional interests. No need to hold all, choose one or two with high conviction and reasonable allocation, maybe 5% to 10% of your portfolio combined. Then explore Layer 2s and scalability solutions. As Ethereum scales, Layer 2s like Arbitrum, Optimism, ZK Sync, and Starknet become crucial. They provide cheaper, faster transactions while benefiting from Ethereum's security. Some have native tokens, others may airdrop in the future. Long-term exposure to these scaling solutions lines you with the direction of crypto infrastructure. But be selective. Not every Layer 2 will win. Focus on those with user growth, developer traction, and ecosystem grants. Next, consider DeFi. Decentralized finance aims to rebuild traditional financial services on open, permissionless networks. Lending, borrowing, trading, yield farming, options DeFi protocols like Half, Compound, Uniswap, Curve, and MakerDAO enable these functions. Investing in DeFi means betting on an open financial system that removes intermediaries. But it also means navigating governance risk, smart contract risk, and regulation. Keep DeFi exposure under control, maybe 5% to 15% total across projects you've researched deeply. Now think about infrastructure plays. These include oracles like Chainlink, data availability layers like Celestia, interoperability protocols like Cosmos and Polkadot, and storage networks like Arweave or Filecoin. These are not consumer-facing but serve critical back-end roles. Without them, the crypto economy doesn't function. Because they are less hype, they offer asymmetric upside but require patience. Allocate modestly and monitor progress over time. You might also explore niche sectors like Web3 identity, gaming, decentralized social networks, and privacy tech. These are high-risk, high-reward plays. They are at the bleeding edge of crypto innovation. A small allocation, maybe 1% to 5%, can provide exposure without endangering your core capital. Now, what about stablecoins? While not investment vehicles per se, stablecoins offer capital preservation, liquidity, and on-chain optionality. Holding some of your portfolio in US or DAI allows you to respond to opportunities without off-ramping. Think of stablecoins as your dry powder. You don't earn gains from them, but you avoid being fully exposed during downturns. Some advanced investors even stake or lend stablecoins for yield. Just remember, stablecoins are only as stable as their backing interest. Diversify exposure and monitor regulation closely. Another layer is yield generation. Long-term holders can stake assets like ETH, delegate tokens in proof-of-stake chains, or lend on reputable DeFi protocols to earn passive income. But yield is never free. There are smart contract risks, slippage risks, and liquidity risks. Don't chase high APYs without understanding the mechanics. A modest yield with strong security is always better than a flashy number that can disappear overnight. Then there's rebalancing. A long-term portfolio isn't static. It evolves. Maybe your Solana position triples, and now it's overweight. Or maybe a certain sector underperforms and becomes insignificant. Rebalancing brings your portfolio back to target allocations. You can do this quarterly, semi-annually, or based on percentage thresholds. Rebalancing forces you to sell high and buy low, a practice that enhances returns and reduces emotional bias. Risk management is everything. Set clear allocation caps. No single altcoin should be more than 5% to 10% of your portfolio unless you have deep conviction and insight. Avoid YOLO bets. Diversify across use cases, but don't over-diversify. Owning 100 coins means you don't really know any. Depth matters more than width. Also, understand liquidity. Some tokens may have low volume or be hard to sell during stress. If you're investing large amounts, make sure the market can absorb your exit without massive slippage. This is often overlooked until it's too late. Think globally. The crypto market moves 24/7. News from Asia, regulation from Europe, tech upgrades from Silicon Valley, it all matters. Subscribe to credible newsletters. Follow dev updates. Watch wallets. Track treasury movements. Stay informed, but don't get overwhelmed. Curate your inputs. Security is non-negotiable. Use hardware wallets for cold storage. Enable 2FA on exchanges. Split holdings across wallets. Be cautious of phishing links. Never share your seed phrase. Long-term gains mean nothing if your assets are stolen. Protect your portfolio like your life depends on it, because financially it might. Taxes matter. In many jurisdictions, crypto gains are taxable. Understand the laws in your country. Use tools to track trades, calculate gains, and file correctly. Mistakes can be costly. Planning can save you more than you think. Emotional control is part of your strategy. You'll see 30% crashes. You'll see 200% pumps. You'll feel fear, euphoria, doubt, and greed. Long-term success comes from stability. Have a plan. Stick to it. Don't FOMO in or panic out. Remember, volatility is the cost of admission in crypto. Accept it. Embrace it. Use it wisely. Never stop learning. Crypto evolves faster than any other market. What works today may not work next year. Protocols upgrade. Narrative shift. Winners rotate. Be humble. Be adaptable. Be a student of the space. And finally, know your why. Why are you building a crypto portfolio? For freedom. For future wealth. For access to innovation. Anchor yourself in that why. Because when the charts get rough and sentiment turns dark, your why will keep you grounded. Building a crypto portfolio for long-term gains isn't about predicting the future. It's about preparing for it. With clarity. With curiosity. With conviction. You're not just investing in assets, you're investing in a movement. A transformation. A reimagining of how value is created, transferred, and preserved. So be intentional. Be strategic. And build a portfolio that reflects not just where the market is, but where you believe it's going. That's how you position for long-term gains. That's how you turn conviction into compounding. And that's how you build not just wealth, but wisdom along the way.